for 3rd of April. For technical analysis today, we have for S&P 500 as well as Yanlong Land Group Limited. As for macro and sector outlook, we'll have a summary of our Singapore second quarter equity strategy, which was held on Saturday last week. Okay, so just our usual disclaimer that the information provided is solely for educational purposes. And you should consult, you should seek advice from a financial advisor before investing in such products. So for S&P 500, the chart over here, we actually broke out of this descending broadening wedge pattern over here, which was a bullish pattern, and we continue to trade in this channel over here. So for this week, we could possibly retest this uptrend support line over here. So the current resistance could be quite near over here. So with the upper band of the resistance being near to 4,200 level, which was a swing high level in February this year. For the immediate support level, we see a pullback. We could possibly retest this wedge breakout over here near the 4,000 point level, with a lower support being at near the 3,900 level. Should we do a deeper pullback? Okay, for individual stock wise, there's Yanlong Land Group Limited. So for this, we have a technical buy at 86.5 cents. The take profit can be set at 95.5 cents. Stop loss can be placed at 84 cents, and the stop loss closed at 91 cents on Friday. So Yanlong, there's a potential retest of this 95.5 cents previous swing low support level in November of last year, which could be acting as a resistance now. So despite price actually trending down recently in this stretch, as shown in the chart over here, there was some short-term rebound. There could be a short-term rebound taking place because as price move into this towards this trendline support region over here, as price made a lower low into the support, there was bullish divergence seen on the RSI, which provides a bullish signal. As well as we can see the MACD flattening out over here and before making a positive crossover. So there's a confluence of bullish signals for short-term rebound for Yanlong to possibly retest this 95.5 cents level over here. So that's all from me for the technicals. For now, I'll pass on my time to Paul to give us a summary of our second quarter equity strategy.
Yeah, thanks, Simon. So as usual, after our usual quarterly strategy, we usually just give a quick summary in the following week. So apologies if you already attended it. So I guess you just have to bear with it. We're gonna run through this again. Next slide. But this is just going to be a summary. Next slide. So we'll just go through the first quarter performance. This is basically a chart of the asset classes. So on the far left is of course Singapore market. It was basically flat in year to date 2023 for first quarter 23. Of course, last year we look at the bar chart. It's one of the best performing equity markets apart from a commodity ETF. That's the dark blue line for 2022. Then REITs have started to recover a little bit. Then Asia ex Japan also rebounded. Surprisingly, could have been more. I guess since it's supposed to be all the Chinese tech names and the China recovery story. The US markets recovered after I guess a very brutal year last year. So one of the best performing markets was Nasdaq up 17, bonds and gold, and then the worst performer has been commodity ETF. Maybe not so today because the oil price has spiked up so much. Next slide. So in terms of the stocks that perform, you look on the far left, banks have been sluggish. I think it was dragged especially hard. I think because of what happened in some of the banks in the US, and of course DBS had that accident. The best performance was really Sembcorp Industries Capital. The conglomerates did very well last quarter. Sembcorp, I think last month was up about 20%. REITs across the board have also been recovering, led by Capital DC. Cyclicals was actually one of the worst performers. Cyclicals as in like Yang Zhejiang, Capacity Development, and also Thai Bev. Yeah. Next slide. So in terms of macro teams, so these are the teams that we just want to guide investors that these are the things how we think will influence investors' decision, or this is what we think is going to happen the following quarter. So the first thing is we think there'll be a sharper fall in inflation. Next slide. Yeah. Okay. Yeah. So actually, I forgot to. So the title of our report was "More Patient Than the Fed." I think we just released our strategy report this morning. So the two reasons why the title of report is "More Patient Than the Fed" is because we think the Fed is still looking at inflation, which is rising, but we think all the real-time data is coming down. And the second thing is we think growth is slowing down despite the Fed keeps on looking at employment. So if you look at inflation, which the Fed says is still rising, but when you look at real-time data, of course, this hasn't really adjusted for today's yesterday's oil price. But do note that oil price hit about 130, probably $100+ a year ago. So year on year, I think commodity price will still be coming down, even though it just rebounded probably the last 1-2 days. So when we look at the CPI, if you look at this chart, there's a very strong link between inflation and commodity price for obvious reasons. But you can see that commodity prices have collapsed very sharply recently, led by energy. The other real-time data which we took it out is the other things that is rental is also coming down, logistics cost is also coming down. So what we're just trying to say is that that real-time data continues to deteriorate quite sharply, and CPI will be a lag. Next slide. So the next one is the other theme we think is US recession. Next slide. So next slide. Yeah. So most of the leading indicators all point downwards as per our strategy session. But when you look at some of the real-time data, if you look at imports, so this is the amount of containers, like our PSA, the amount of containers that go through the LA port. Of course, there's another Long Beach, but they there are a few ports there, but this is one of the main ones. And most of them trend in line. So you can see the blue line that year-on-year container is actually collapsing, or US imports is collapsing very sharply. You can see that this blue line is almost similar to the contraction that we saw in the global financial crisis. It's actually the contraction is actually worse than pandemic time. But of course, during the pandemic, you can see the amount of containers spiked up because everybody was just ordering goods. The shaded line is just the amount of containers, although it's a bit hard to see. So what we're trying to say is that imports are collapsing in the US worse than the global financial crisis. Next slide. Although what you see is that retail sales is doing well, but it's mainly coming from services. Like half of the growth comes from restaurants. So what is happening in the US is that the consumers are spending a lot more, or half their spending is on services such as restaurants and leisure and entertainment and so forth. So one of the issues is that we think maybe the manufacturing sector is probably facing some recession now because there's just too much inventory. So in the US, you can see that the retail inventory has spiked up to 700 plus million of 650 billion. So this is a record high. And I think I didn't include the January 2023 number. I think that's already hit like probably 743 billion. So there's just too much inventory. So most exporters, I think we've already seen some of it. What happened in probably end of last year. I'm not sure the situation now, but at least end of last year, a lot of Vietnam factories had to shut because the orders for textiles or shoes all collapsed because of what's happening in the US. There's just too much inventory. And most electronic exporters also mentioning this, that there's a slowdown in customer orders. Next slide. So although recession is there, but I think if you just look at newspapers or magazines or any reports, I think the talk of recession has been around since June of 2022. So recession news isn't new, and the market has already kind of priced some of this. So this is the monthly S&P chart. So what we did was we take the peak, that means the highest point to the lowest point, peak to trough. Then what you can see is that the market is already factoring some weakness and some expectations of recession. So unless we get something like a global financial crisis, then you're talking of 40-50%, or then that is the most severe. I guess that's the major hard landing scenario. But I think we think any recession will be modest. So that's why we think the market is really priced in some. So you can see during recessions, the market can drop maybe mid-teens to high 20, like 16 or minus 24. So the US already kind of factored in some of this decline up to the 31st of March. Next slide. then of course the Fed will always mention about employment, that jobs is being very robust, but no, employment is notoriously a lagging indicator. So even though by the time unemployment, so this chart is the unemployment rate, and you can see the blue line always spikes up during recession. So by the time the Fed says that, think the employment picture is getting worse, it's a bit too late because it's a lagging. So they should try and anticipate this line before only reacting to it. So during recessions, unemployment can spike maybe 2 to 3%. I think right now it's more or less flat at the record low. You can see the blue chart is probably like 3.4, 3.5%. Next slide. So the other thing we think is that the Fed can't raise rates. So the first reason is next slide. So the first one is because just using Silicon Valley Bank as an example. So when their deposits tripled from 60 to 170 billion, which is huge, it basically means the bank actually tripled in size, 60 to 173 billion. So what they did was they took most of the money. Some of it they lent out. You can see the blue color bar. They lent out of the 100 billion extra. They took out maybe 1/3 went into loans. The other 2/3 they parked it into government securities and mortgage. But all this, the values dropped because the Fed raised rates, and then they suffered a loss of almost 14 billion at the held to maturity. But you don't have to recognize this loss because for accounting purpose, even the central bank allow you, because if you don't sell it, then it's fine, because these are government bonds. So at the end of maybe 3 to 5 years when it matures, you will get your $100 or your par value back. But the problem was they were losing 14 billion, and that was almost all the equity. I think that doesn't matter because you don't have to take the losses. But if the depositors start to withdraw money, then you only have 14 billion cash. You're obviously going to take in some of these losses. So you have to sell all these, the one in beige, to fund all the withdrawals of 40 billion. So then of course all your capital is basically wiped out, because you're forced to sell all your securities. So if the Fed keeps on raising rates, I think there's 1.7 trillion of securities owned by the banks. So if they keep raising rates, then the treasury, then you will just put more pressure on the government securities, and there'll be more losses on the bank's balance sheet. But of course, recently the 10-year government bond yields have actually dropped, so that's helpful. Next slide. Is there me or is there a lag? Next slide. Yeah. Okay, so the other thing why we think the banks, so the first reason is if the Fed raise rates is going to hurt their balance sheet. The second reason is the bank tightening standards. So what has happened is that even before the recent collapse in Silicon Valley Bank, the banks in the US were already tightening. So this is a survey. US got all kinds of data. So this is a survey they do with the banks to say, are you tightening? That means, are you not lending more? I mean, it's a fancy word, but basically, are you going to lend more or you're not going to lend more? So most of them say they're tightening. Most of them are tightening because at that time they see that the growth in the US is slowing down. But this is before. So with the banking crisis, do you think this will tighten even more? You might probably go back to where we see in global financial crisis, you see the chart in 2007, 2008. So this time around, the banks will not only just tighten because they are fearful of the economy, but they also need to show up because they want to be liquid. I mean, most banks will now want to be liquid. They're not going to tie up because they don't want to have another run and then they cannot meet the deposit. So if you're a CEO, I mean, most CEOs not going to want to lose their job. So obviously they're going to keep it liquid. So they're going to tighten even more. So either they don't lend, or maybe they may not even, maybe there'll be no new lending, maybe they won't refinance, and so forth. And so these are the reasons why we think the Fed will be hard. And this tightening is already a form of higher interest rates, which the Fed already mentioned. Next slide. So the thing, just the last point here is that, but just that when the Fed cut rates, it may not really mean the stock market has bottomed. So if you look at these three circles here, so when the Fed cut rate in 2001, you can see the blue line, the market still continues to drop. Likewise in 2000 and global financial crisis. So although the Fed cut rates, actually the market will normally rally the first 1-2 days, but the market longer term doesn't really bottom. So of course this is a bit of a worry, but again, it really depends how fast the economy recovers. So like during 2020, during the COVID recession, when the Fed cut rates, actually 1 month later the market more or less bottom, because of course maybe the time at the point in time the US government started to increase their fiscal spending. So it all depends how after the Fed cut rates how deep the recession will be. It's very hard to time this. So sometimes can be 1 month cut rate, then the market bottom 1 month. You cut rate, the market can even bottom only like more than a year later. So this is something to take note of. But we don't think, unless we will get a really deep recession in like 2007, then the Fed cut rates then might maybe bottom, we guess, maybe 1 month or 2 months later. It will not be that long. Again, because it doesn't really repeat all the time. Next slide. Okay, the next one, in the Singapore economy, next slide. Yeah. So for us, the external environment is deteriorating quite sharply. I think you will see that Singapore exports are down very sharply. Even if you take a chart of Taiwan exports, Korean exports, they all show the same thing. Exports is just collapsing. So this will be the biggest drag for Singapore's growth, GDP growth. Yeah, next slide. Okay, but the economy is still resilient because we got foreign direct investments. Tourism is coming back, and tourism is like 5 percentage points of GDP. And we got very robust construction sector. The other thing that might be happening is that the population need to recover faster, because if you recall, so this line, the red line is, during the white paper, there were 2 population scenarios. One is 6.5 million by 2030 and 6.9 million by 20, the low and high case. So, I mean, this is not a chart about whether how congested Singapore will be. I mean, that's not the point. The point here is that if the current population is 5.6 million, I think the authorities have mentioned that their planning scenario for infrastructure is 6.9. So, I think it'll be a bit strange if they prepare everything for 6.9, but the population is going to stay at these levels. So we think the population might hit to maybe the low case, and this is important, because Singapore is aging fast. I think 1 in 4 will be 65 and above. So that means a lot of we won't have a very strong workforce. So without the stronger population, basically there will be a lot of jobs that cannot be fulfilled, and the country cannot grow. So I mean, this is holistically, but this is going to be good for those who have business. Like we said, could be a LHN that has rental, could be a Sheng Siong that has supermarket, because more population means more business. I mean, in a nutshell, it's pretty obvious. But again, this is quite a positive structural story if the population recovers for Singapore. Next slide. Okay, so I'll hand it over to Zane on the technical.
Okay, thanks, Paul. So I'll give a technical pulse of the outlook of the Singapore market in the coming quarter, as well as some 2 individual stocks that maybe you can look out for. Okay, so for the Singapore market, we take a look at this ES3 ETF. So this is an ETF that actually tracks the local blue chips. So it's something that you can look to trade if you are interested in that. So currently, this is the weekly chart. We have actually just been tightening in this wedge consolidation over here. So this has actually been spanning since 2021 over here. So it's quite long. Over here, the current support is around 3.15 to about 3.2 over here. Where we saw actually there was a rebound after retesting this support line. As for the resistance wise, I think it's around 3.28 to about 3.32 over now. Which is the 50% to 61.8% Fibonacci retracement area. So for now, for this quarter, we could possibly see continued shrinking volatility, as well as tightening into this wedge before we decide direction, whether we break out upwards or downwards. Yeah. So for the second quarter target, we are looking at about 3.15 to about 3.3 in this zone over here. Okay, so for large cap, I have city developments. So for CDL, there's a possible pullback towards this uptrend channel support over here for a possible entry. For CDL, we have seen quite a large, it's quite a deep pullback ever since we hit about $8.40 level over here. currently we're sort of price has been consolidating in a channel over here. But if we do see a slightly further pullback towards this main uptrend channel, which is quite a strong uptrend channel since 2021, which also coincides with 61.8% retracement level at $6.94. Possible buy entry near $7 could bring us about over 11% upside potentially if price managed to bounce back up to about $7.80 in this resistance zone over here. Okay, so for another topic would be Suntec REIT. For Suntec, the trend has been pretty nice to see. So we have actually changed from a downtrend over here since the second half of last year towards a uptrend over here this year. So for Suntec, there could be a confluence of three supports at a $1.39 level. So the first one being the uptrend channel support over here. The second being the horizontal level support, which was a prior resistance. We can see a prior strong resistance in December of last year. The actor has managed to act as support upon a retest in February this year. So if we do see a retest of 139 again, we could see some support coming in again. And then the third one being it's the $1.38 level is a 50% Fibonacci retracement level. When you take the lows at $1.30 and the highs at $1.46 over here. So that's the three supports I'm talking about. Okay, so for resistance upside target wise, we could possibly be looking at $1.55, which is a 61.8% retracement level and close to a previous swing highs back in last year. And over here, if we see price moving up steadily towards this level in the second quarter of this year, it would meet with this uptrend channel resistance as well. So if you do get there, there could be a possible about 11.5% upside, possibly for Suntec to consider this trade. So that's all for me now. Pass on the time to Darren to talk about the REITs sector trends.
Thanks, Zaid. So for REITs, we have a tactical overweight because we think investors will start piling back into these safer yield playing instruments as there are a lot of uncertainties going forward in the stock market and a lot of recessionary concerns. So this overweight is a tactical overweight rather than from a standpoint where there's a lot of growth and a lot of potential for capital appreciation, mainly because of the high interest rates. When the REITs refinance their loans, they'll start to incur higher interest, and that will affect their will eat into their DPU. So DPU growth potential in the near term, like 1 to 2 years going forward, is quite challenging because of that. So from this graph, we see this is the yield spread. The red line is the average, the 10-year average, and then right now the graph is going to hit the 10-year average already, and is probably going to even higher than 10-year average. So how we read this, right, is the dividend yield minus the 10-year Singapore government savings bond. The 10-year Singapore government savings bond is like a proxy to the risk-free rate, or rather, you can think of it like a fixed deposit where there's no risk. So how much you're being compensated by investing in S-REITs over the risk-free rate, like the spread you get. So the higher spread is better. So right now you see it's almost creeping back towards a 10-year average when it's been trading almost at -2 standard deviation for the whole of 2022. So yeah, as this recovers, we believe it's starting to look attractive to invest in REITs. But one thing to note is that the yield spread is going up because the 10-year SGS kind of the yield went down by about 50 basis points rather than the S-REITs dividend yield decreasing. Increasing rather, yeah. Next slide, please. Yeah, so this chart is the valuations chart. How do you read this? Is on the left side is the price book, and on the bottom side is the dividend yield. So towards the bottom right, if shares are trading there or the REITs are trading there, is considered cheap. Like you can see the overseas REITs like Core, Prime, and Manulife that trading at steep discounts and high dividend yield. Probably because the share price kind of crashed or corrected because there are many bad news in the market, and I mean, because of the high interest rate. But high interest rate affects the whole REIT market in general. But mainly because of all the office, like in gateway cities where all the office, a lot of the tenants are moving out from California, etc. So yeah, they're quite affected by the negative sentiment there. And for the top left-hand corner is the expensive part, where we see REITs like like Parkway Life REIT, they're trading at about 1.6 times and about 4 times dividend yield. So what we see here, a lot of the Singapore listed REITs with Singapore assets are trading around the 1 times price to book with about 4 to 7% dividend yield. So yeah, that's around that's where all of the Singapore asset, the REITs with Singapore assets are trading at. Yeah, next slide, please. Yeah, so for this chart is actually the sensitivity analysis for 1% rise in interest rates. So for example, if you look at Prime, because Prime is about 86% hedged, their loan book. So a 1% rise in interest rates will only affect them will affect their DPU by 1%. While if they are not hedged, they are fully unhedged, will affect them by 8%. So therefore, in the current environment, or rather the past year for the FY22, it was very important. It was key for the REITs to have their loan books hedged. But going forward, we believe that since interest rates have peaked and the hedging cost is so expensive now, a lot of the REITs may consider to lower their hedging ratio because of a few reasons. One of it is, let's say if you lock in a high hedging ratio, then you're kind of locking in the higher rate for the near term. But then if the interest rates start to go down, then you're kind of losing money on that front. And then another reason is because if for capital, for rather liquidity, if they want to perhaps do acquisitions or divestments, they might need to unwind their hedging positions. Yeah, so when they do that, they incur some cost there. So it's quite challenging for REITs also to take on a strategy of whether to hedge or not to hedge going forward. Yeah, because of the current peaking of interest rates. Yeah, next slide, please. Yeah, so for the subsector preferences, we prefer hospitality still, mainly because of the recovery of RevPAR. As you can see in the red chart, the red line, RevPAR numbers are already way above pre-COVID levels, especially in the last quarter of 2022, especially because of key events like the Formula One. So that really spiked up the RevPAR. And then because of seasonality, like in January is not really a holiday period, so the RevPAR kind of dipped from the December period. It's more seasonality than demand issues rather, I would say. So even though it dipped, it's still higher than Jan 2019 levels by about 5%. So the RevPAR is still doing good. But then from what we see here, even though the RevPAR is good, the visitor arrivals has not recovered to pre-COVID. So with the return of China travelers that we expect probably in the second half of 2022, we think this RevPAR will continue to go forward and increase its upward trajectory. Yeah, so I think that's all for me for the REITs. I'll hand over to Paul for the banks.
Thanks. So for the banking sector, we still think there's earnings growth for the banks. I think maybe around mid-teens growth. So one of the reasons is, of course, no stranger. I think most of us know that net interest margin has been rising. So the blue line is the US interest rates, and you can see that the Singapore interest rates and US have a very high correlation. This is a bit unusual because some countries have their own central banks and they may not actually raise as aggressive as the US. But for us, I think we follow almost like a 90% correlation or more. So what we think is that although we've seen bank earnings improve, but the real impact on interest rates only happened in the second half of last year. So we have another at least another 2 more quarters of strong results. So just to give you a sense, so if you look at the bank NIMs, the increase was only about 32, only started in the second half. So most of the banks, if you look at the table in the middle, their net interest margins, for instance, for DBS, their net interest margins for the 2022 was 1.75, but they exited the year. That means they exited the year at 2%. So that means, and interest rates continue to rise. So unless interest rates collapse, then only you feel it, or their CASA totally collapse. But for us, we think they exited at 2 and they're guiding at 2.2. So there's at least another although we are expecting 2023 to be 32 basis points, I think some of the banks are guiding maybe even 40, 50 basis points higher. And I think SORA actually continued to climb up. So first quarter is going to be another strong quarter for the bank earnings, at least at the very minimum from the driven by all this NIM expansion. Next slide. So the other part is CASA. So we just want to remind investors that CASA is always the bank's golden goose. So CASA, so how banks enjoy such a strong NIM is because, firstly, more important is that their loans, I think 70% is variable rate loans. So if you want to talk about any business that want to pass the higher costs, then I think banks is the one, because they definitely can pass the higher cost to all the housing borrowers. Then the second strength, or the second reason the NIM expand is because they have zero cost interest rate deposits or loans, and also any company that can enjoy zero interest rate loans obviously going to benefit, because you either take it to put it in short-term paper, or put it and lend it out as loans. So although CASA is definitely will be dropping somewhat, because you can see from the table here, the industry loans, the amount of CASA peaked at maybe 390 to about 350, which is understandable, but DBS and OCBC still have a huge amount of CASA. So even if DBS dropped to, let's say, 300 billion, a 0.5 basis point, they're still going to make 1.5 billion, because without doing much, just taking it as parking into because most of their assets can reprice faster. So even at 300 billion, it's still a huge incremental growth for the net interest, for their earnings, even at a 50 basis points increase. Likewise for OCBC and UOB. Next slide. So again, just to refresh, I think we probably mentioned this before, but just to do the same thing to compare between the three banks. So the column in the SVB means Silicon Valley Bank, middle is Credit Suisse, then Singapore banks. So when you look at the capital, that means the amount of capital all the banks have, more or less quite the same. I think if you had bought a AT1 because of Credit Suisse, a high capital ratio, we can't really blame you for that, because their capital CET1 is pretty high, as good as the Singapore banks. But the problem for Credit Suisse was just the 2 years of losses that they face. For Silicon Valley Bank, I guess that's more obvious, because most of their assets they took and then they park it into government securities, and like we mentioned earlier, the value of these securities just collapsed. I think maybe, I don't know, 10-15%, maybe for them at least. Whereas Singapore banks have very little of that. So Singapore banks do recognize some of these losses, but it may not come up in the P&L. It comes out in the comprehensive income. So one of the questions we had was this. So that's why the Singapore bank's book value may not actually move as much as their earnings, because they actually do have some of these losses in their balance sheet. But again, it's just the degree. It's just that it's not as much as the rest as Silicon Valley Bank, I guess. Next slide. Okay, so the other thing we see for construction sector, we have an overweight. So one of the interesting thing for construction is that, in the past, construction sector was like some years good, some years bad, some years good, some years bad. So of course, investors don't like such volatility. But from 2021 onwards, which I think until up to 2007, I think the construction contracts awarded will be very stable. The forecast here is not ours, is from BCA, which tends to have a very accurate record of construction contracts. So this is construction contracts awarded by the public sector and the private sector. So the difference right now is that if you look at the table on the far right, so this is the government budget. So operating revenue for government, every February, government talks about the budget. So the operating revenue refers to, the amount of taxes they collect, GST. The middle one, net investment return, is the assumed return that they get from Temasek and GLC. Then there's this new category called capitalization of infrastructure. So this is basically the amount of money they spend on infrastructure. So maybe 2.3 billion they spend, but they actually put it back in revenue, which the only purpose you do it is because it's like normal accounting. Rather than take it on the balance sheet, expense it, they capitalize it. So that means the government the authorities can spend on infrastructure project and it doesn't hit their budget. So the government has authorities have allocated 90 billion under this Singa bonds. It's called significant infrastructure. I can't remember the last three acronym, but it's significant infrastructure. National government. Yeah. So what's important of that is that the government authorities can spend more than before. So they got this additional 90 billion, and this 90 billion on pay won't be reflected in the usual budget that we have. Until quite late, until either the project is completed, then they do like any other company do depreciation, but right now they will recognize only the interest. So as a result of that, in the near term, construction contracts will be very strong. We don't recommend the contractors, but we prefer the building material companies like the BRC and Penn United, because these companies have market share of 40% and above. And if you have any industry in Singapore that has 40% market share and above, obviously it's a very attractive stock or company to be invested in. Next slide. So for semiconductor, contraction is usual contraction is 13 months. Doesn't mean every downturn is 13 months. So this red chart is the global semiconductor sales 3-month moving average. So just to show you a trend now, of course, it's volatile, and any downturn can last as long as 13, sometimes 17 to 16. But right now we've contracted. That means year-on-year decline. That means the year-on-year weakness has been on the downturn, year-on-year contraction, sorry, it's been on for 6 months so far. So this time round, it is up to the usual period is 13 months. So we think the weakness could continue until the month end. But our message is to be ready for growth, because most of the Singapore listed construction semiconductor companies that service the equipment, because most of it cost service equipment, I think very few do back end. Maybe Micromechanics does, but even then they're also moving to front end. So front end semiconductor refers to those wafer fabs that is your applied materials, your Lam Research, which companies like TSMC, the fabs use. So this is the cutting edge equipment. So right now like we all see in the news, Applied Materials is setting up a 600 million plant. So a lot of them are shifting their more of their supply chain into Southeast Asia, namely Malaysia and Singapore, as they prepare for the next upcycle. So when the next upcycle comes, I think the growth will be just as strong because they got new customers. We also see it like in Grand Venture, they hardly go into front end, but because so many suppliers are coming into the region, so they managed to break through into the front end equipment, which is one of the toughest. Of course, you also have to spend a lot of equipment, but they managed to do so. But electronics is going to be weak in the near term. Most customers are cutting back orders, or they're also delaying launches because they're nervous of the global environment, or because their old products cannot sell out. They got too much inventory, so they just slow down on doing any new launch. Next slide. But it's a sector to go back in. Next slide. Okay, so for property, so this table, the blue bar is the amount unsold. Doesn't mean not unsold. Means sometimes these are just not launched, or some have planning permit and not yet launched. Some haven't had their permit launched. So it doesn't mean that this is like inventory or it's like finished inventory. So this doesn't mean this inventory that's completed, like hanging in the market. Nobody wants it. So just to clarify on that. So at the peak, there was like 35,000. If you look at the blue bar, 35,000 inventory. Right now, it's dropped to 16,000. So it's pretty low. Of course, the red line is a bit worrying because it means that the inventory to sales, that means how much inventory you have out there to sell. Of course, the lower, the better. So it climbed out a lot because last year there was only 7,000 units sold. 7,000 units sold of new launches. Although there was only 4,000, but because some of it was existing inventory. But because these are very low numbers, so the red line might be a bit deceptive because there wasn't many launches last year, so it shows that the sales are slower. But again, in absolute numbers, you are talking of very low inventory. You can see the record lows are probably the decade lows is probably like 14,000. So inventory is still very thin. Although this year there's going to be 11,000 new launch compared to last year's 4,000. Next slide. So for telcos, it's going to be weak. So telcos is a bit troubling. So what has happened is of StarHub's numbers, you can see it has dropped from 200 million to 149. Part of it was because of the roaming revenue. supposed to recover, but because I think they're going to spend almost 300 million the next 3 years to kind of revamp their technology and also to spend on EPL. Not sure why, but anyway. You can also see telco for Singtel from the peak of 3.6 billion is collapsed quite a lot. So telcos is just structurally weak. There's really not much growth in the sector. Everyone that has a phone has a phone, and if you want 5G, 5G just makes, I don't know, you want to, unless you're a hardcore gamer, there's the demand for 5G isn't that strong. There's no real so-called killer app. The other issue that Singtel has is just Australia. So Australia profitability has collapsed quite significantly, in part because they lost the NBN. Basically, the whole broadband business was, I guess, taken back by the authorities. The only strength they have now is India. The two parts for Singtel that might do well is the NCS, but that's loss making now. But they're trying to groom that, and the data centers. So they have another, I think 2 more huge data centers coming up. And then once you turn on data centers, of course, the earnings can jump. So that will only come in 2024. Next slide. Okay, so this slide is just for topical discussion. I think those who attended, you probably heard it. So again, just to remind everyone, which we also concur with what the MAS says. So Bitcoin is not medium exchange, not a store of value. Bitcoin is not a unit of account, but I guess it's a huge fun speculative tool, because if you look at this blue line, this is the Grayscale Bitcoin Trust. It's like a closed-end fund for Bitcoin. It actually up almost 80% this year. Of course, it collapsed. You can see with the blue line. Sorry, I should have put right-hand side. My apologies. So it actually refers to, I think, the index on the far right. So this is the index of 100. This isn't really the actual price. So this shows that we index it because it was a bit hard to scale it. So this is an index. So if you look at this index, the blue line from 100 it jumped all the way to 1,002, 10 times for Bitcoin, this great trust, and then from that it dropped down all the way to 200. Then now it went back to 400 because it kind of doubled. So the other thing is also the gold and bonds. So for us, we think that if you want to bet lower interest rates, probably bonds is the one, because gold has really kind of, it's a hedging tool, and it really kind of reflected the recent collapse in banks. Next slide. Okay, so we also, as highlighted, we meet a lots of companies. I mean, about every week we have lots of meetings, but so not every sector we cover, and sometimes by the time we cover, we're a bit late too, right? Because some of these stocks move so fast. So, but some of the sectors, so not all doom and gloom in Singapore. So some of the sectors that are performing well, we're always very hesitant to mention Chinese companies, because Hong Kong is obviously the more fertile place to get Hong Kong stocks, and the volume is so much better. But so for China travel, there are many ways to play China travel. But for China aviation, one unique thing is that the one jewel they have is that in the Shanghai Pudong Airport, if you're going to, the outbound there's only one petrol pump there for any airlines trying to fly out of Shanghai Pudong. There's only one petrol kiosk to use, which they own 33%. And this business is apart from being captive, it's just a volume game, because the margin is all quite fixed. It's a cost plus margin. So they used to make 20 million now. They used to make 80 million at the peak, and then now 20 million. So if passenger travel returns, you can see directionally it is there, but of course the pace of the recovery, nobody knows whether it will bounce back faster, slower. But at least directionally, that the volume should recover, since there'll be more outbound travel from China, since it was hardly anything last year. China consumer, the unique thing for Sosio is that they pay out. So for this, if Chinese consumers spending recover, you will get it in the dividend yield. It's not just a share price gain, which most small caps in Singapore, you hardly can get that. So their yield, if you take out the sponsor support, the yield right now is probably about 7, but with sponsor support is about 9. So they are relying a lot on GTO. So for them, it is not just rent, but most of it actually comes from GTO. That means they take a share of the tenant sales. So they're really almost a pure play on Chinese consumer, because they take GTO. That means they share the revenue of the tenant. Not so much for the rental, they still take, but it's not as much. Of course, then GHY, if you like J Chow, so they organize J Chow concerts, and there's an insatiable. You talk about pent up demand. There wasn't any concert in China for almost, I guess, 3 years. So right now, it's not about whether there's demand or whether how expensive you can charge. It's whether you can get any venues. So it's of course there are shipyards, no, Sembcorp Marine, I think we all know, and Dynamic, no, probably a less well known, but they are the ones constructing all the FPSOs, and the demand is strong for FPSOs. It's sometimes just not enough capacity out there. Then if you want to play vessel owners, remember we used to have our Ezra, Ezion. So most of them, of course, we know sadly have all been knocked out. So the only one left standing is kind of, I guess, Marco Polo. There are a few more names, but I think they're all very illiquid. And not only are they benefiting from higher oil price because they actually own EHTS, but they also benefit because they're also ordering vessels to help in the offshore wind installation. So what is happening right now in Taiwan is you're going to install offshore wind, those big turbine that you see in the sea, of course, may not be the nice looking thing to look at, but to build that, you need a lot of vessels to bring and to install. So they have a vessel that they call it a CSV, where it's like a vessel with a very nice elevator, because to install this, you need to bring the engineers up. So just as a very, I guess, the most expensive elevator or lift, sorry, not elevator, sorry, the most expensive lift to bring the engineers up. So they benefit because not only are they getting, because oil price is up, they also getting contracts for vessels to install wind farms, not only in Japan, but in Taiwan, but the next phase should be in Japan. So next slide. Okay, so these are our stock picks. Next slide. So next slide. So this is our model portfolio. So the 3 new additions we add was FCT, because we are overweight on REITs, and PropNext, because of the yield of 7% and the better earnings visibility, and capital land investment, which we'll discuss later. So those that we took out, I mean, Prime did well in January, then dropped in February because the Fed was raising rates, or maybe people were worried that raise rates higher. And in March, Prime US REIT also dropped because of what's happened in the US, the Silicon Valley Bank. And in the background, there were also 1 or 2 funds that own commercial property that collapsed. So it's almost like guilty by association, because the whole industry has been, all the news flow is big. So one of the reasons we took out, although we have a buy call, is just we are just very worried of the news flow, because there's almost 400 to 500 billion of commercial property for refinancing, and not everyone is going to be refi. The difference for Prime is they don't have they don't have that many gateway city offices, and their gearing is, I think, 40% or less. Whereas some of the funds in the US, some can be geared as much as 80%. So those are the ones in trouble. But this portfolio, we don't want it to be too volatile. So because of the volatility, we took it out. For Del Monte and HR Net, I mean, we still have buys, just that in the near term, we just worry the earnings. There might be some earnings weakness. For Del Monte, we still like 4 times PE, and our earnings forecast isn't aggressive anyway. Okay, so next slide. So for us, we took a hit, although Prime actually did give a very nice dividend, but we don't add that into the performance. Again, this is just for illustration. We just take we take the portfolio we just rebalance every month to 10%, and then we don't take account dividends, we don't take the brokerage. But again, it's not so much to get to replicate the exact number, but just to give some transparency. At least we know, and if it doesn't do well, we'll just tell you. Yeah. The code there is that if you are a fund manager, this will be probably the client's reply to you. Please, please no more mid-cap names, because we always get hit by the mid-cap names. Next slide. So I'll hand it over to Darren on the REIT.
Yeah, thanks, Paul. Yeah, so for one of our topics is CapitaLand Escort Trust, mainly because of the strong recovery in the RevPAR. And the RevPAR is really back to pre-COVID levels. But we say this, we do not mean that there's no more room to grow, because historically, or rather pre-pandemic, 9% of their CapitaLand Escorts customers are from China, but in 2022, only about 3% contributed. So with the recovery, with the return of these China travelers, we believe that this RevPAR can continue to grow for improve further. So that's one of the reasons. Another reason we like Escort because they still have about 300 million of divestment gains that are sitting in their books. So they can decide to, they are just keeping it there. They can use this for future acquisitions or even distributions to unit holders. So there's a flexibility there. And we also like the stable income and growth income mix. So in FY22, the second half, 52% of their income was from stable sources, meaning the longer stay accommodation as well as the master leases. While the growth income is from the return of the hospitality, like this growth in RevPAR, the 48%. There's a question I see in the chat which says, why is Escort not moving forward steadily, but we track? Even hospitality sector should be topic. So actually, Escort, yeah, they did drop a little bit since the Fed announced that they would increase the rates. So I think that one is more of macro. But then with our target price and our rating of buy with a TP of $1.26, we actually this target price is actually for 1 month time, a 1 year time horizon. So as you know, the Singapore market is quite is not as liquid as the other market. So the prices also move much slower. So that is why we also see that the price will take it won't be so fast like the US tech shares like that. They really move real fast, but Singapore shares not so fast. So yeah, that's to answer your question. Next slide, please. Yeah, our next pick is FCT. FCT because the tenant sales still remain resilient for suburban malls. We think there will be about 20% of 20% more than pre-COVID levels going forward in 2023. But this 20% is kind of slow down from the growth that we've seen in 2022 and 2021. Because of some headwinds like the GST increase from 7 to 8%. So all these are minor headwinds that may affect the tenant sales for FCT and as well as the other retail REITs going forward. But we still think it will maintain around these levels. So another reason we like FCT is because their occupancy cost, which is the rental that they pay over the tenant, rental that tenants pay over the tenant sales that they earn in income. So this occupancy cost is at 16.2%. Pre-COVID is around 17 to 18%, but during COVID it was almost 20%. So because this occupancy cost is still low, it means that the tenants are paying lower rent as compared to the amount of income that they get. So that leaves some room for higher rental reversions going forward for FCT. Another reason is because of the ancillary income, like the return of car park income and the atrium income going forward. This car park income and atrium income before COVID, they used to account for about 5% of their top line. And it only came back in the second quarter of 2022. So going forward with this full recovery, a full opening, we believe that this will contribute more. And right now it's about 6%. In fact, it's really more than pre-COVID levels for this atrium income and car park income. And one thing to note is their recent acquisition of Next. We think it's a good proposition strategically because first of all, FCT is full of suburban malls and Next is one of the largest suburban malls in Singapore. So it's a really good fit. Like yes, many MRTs. It sits on top of 2 MRT lines, 3 in fact. Yeah, but then on whether this acquisition was accretive, we are not so sure because of the interest expense and the utility cost at the vehicle level. So for that, we are not too sure whether it's accretive because right now, FCT together with their sponsor, they acquired 50% of Next. Yeah. So with that, we have accumulated everything on FCT with a target price of $2.31 and a DPU of 5.5%. Yeah, I'll hand over to Paul. Thanks.
Yep. Okay. Yep. Thanks. Yep. Okay. So for this strategy, I'm obviously doing a lot of talking because our analyst couldn't be with us because they're engaged in another. And by the way, I'm not the banking analyst, so that's why you keep. So you have to bear with me listening to my voice for this time round. The next strategy, of course, our analysts will be speaking more. So for Keppel Corp, we still have a buy. So what's next for Keppel Corp after disposing Sembcorp? After disposing Keppel Offshore Marine. So what is next in their monetization plan is to dispose of all the land bank that they have. So we already had a bit of flavor from this. I think last week they sold a Philippines property, which is not even in our table here. I'm not sure. It's probably hidden under under the pillow somewhere. But what we're saying is that the game plan for them is just to monetize a lot of the property right now. So they sold that for almost 200 million and they make a 80 million gain on the recent property company that they sold in Philippines. So the strategy for Keppel Corp is to dispose of all the land bank to monetize and deploy it into their new business, which is essentially the utilities business and so forth. So we still like it because we think during monetization is the best part of it because they can monetize, recognize huge gain, then maybe give dividends. But of course, once they take and deploy into new business, that will take time to get the returns. So it is still fine because they have this 2030 plan to monetize as much assets as possible. So I think this is the main pipeline right now. If you see on the table, there are 40,000. They plan to sell like 4,000 units. A lot of it actually comes from China. So I guess that's the only dampener in the news. But most of the land is mainly in China and in Vietnam. So most of the growth is going to come from these two countries. But for Keppel, it's all about just selling land and monetizing. Next slide. Oh, sorry, I forgot to turn on my video. So the next one is city development. So city development, there's two parts to the story. Like we mentioned, because the inventory is low, so we like it that CDL has units to sell, and they got two projects. That has very low land cost. Not say very low because they never disclosed the amount, but like Fuji Xerox, they were given a plot ratio increase of 25%. So, and they never really mentioned. So they have new launches. The Tembusu Grand is being launched. So that will be an interesting to see how much they sold. So development is one of the catalysts. The other catalyst is also the whole hospitality. So they own Millennium and Coptham. They got about 160 hotels and property and hotel rooms of I think for 38,000. So because of that, there's also that is for us another way to play the recovery in hospitality. So that's why we still have city development. You notice the word under review. So basically, because the analyst is changing, but I mean no change in our view, just that we are changing analysts. We are moving our coverage to another analyst, which is essentially Darren. So that's why we have this thing under review for now. Next slide. DBS again, still like it. The swing factor, of course, like we mentioned earlier, net interest margins will be strong. But the swing factor is going to be fee income. So whether they beat or exceed expectations will be how well fee income, which is essentially the wealth management. So we think there'll be a rebound in fee. You can see from the blue bar here. So fee income dipped quite significantly in 2022, because the market has been exceptionally weak, exceptionally weak, and of course less able to sell products and so forth. But if you look at the structural story for Singapore banks, wealth management is a major structural story. You can see from the fee income from 2015, it has always been growing. But of course, when there are certain shocks like 2020, the pandemic, then you see this decline. But fee income, wealth management is the growth story for Singapore banks in general, because they're going to be the hubs, the wealth management center for the whole region, I guess. Next slide. So the next one is OCBC. We like it because of the dividend yield. We think it's attractive at 5.5. So we just round it out, also close to 6%. Although it's not, it's I think high fives. But when you have such a high dividend, there's also some, I guess, share price protection too, because when you pay such a high dividend, unless there's some major event happening, this stock's not going to trade at 6 or 7%, because especially if interest rates are kind of peaked too. And we also like it because they have a lot of capital. Their capital ratio is the highest among the 3 banks at 15%. And all they have to do is just don't be so defensive, because if they actually raise dividends more, their capital come down a bit and their ROE benefit. So if they raise dividends, they get the benefit. Of course, at AGM, everybody will say thank you. I mean, that's not the benefit, but I mean, the second reason is that the ROE will increase, and when you have a higher ROE, the market will give you higher valuations. Your price to book right now, they're trading at, I think, at book. So the market will give you higher valuation. So you do get that benefit. Just that I think management is just extremely conservative. Like we were kidding, they like to play football with 3 goalkeepers. Next slide. And of course, OCBC and DBS has the benefit of the China reopening story, which should only benefit the banks because they have such their exposure in Hong Kong. So for SGX, we also like them, not because they are doing a lot of listings, which they are not. It's probably the opposite, but we like them because of this blue bar, which is the treasury income, which is basically interest income, rather than just use it. Because they call it treasury income, we call it but one of the reasons is because during the peak, they managed to secure almost 135 million of interest income, and this is even though interest rates were low. So even though SIBOR was around, if you look at the chart here, even though SIBOR was 1.5%, or Fed funds rate was 2.5, they still managed to generate almost 135 million from treasury income. But now that you can see the red line here, Fed funds is hitting 5%, which is double the previous high, and SORA is now 3.5, is double. We think their earnings can surprise because of treasury income or interest income. So they really doubled. They really generate interest income more than the 50. So if you look at the table here, 2022, they generated 50 million in treasury income. First half, they more than doubled to 47, and it should climb. So just to dial back, how they generate so much interest income, which is, I mean, the best, right? You don't have to do any work. I mean, technically, you're earning interest income. I mean, I'm not sure how much work you actually have to do. But one of the reasons why they do, because they have like 14 billion of float from the customers. They call it collateral float. So what happened? I think they only disclose it in their annual report once a year, if I'm not mistaken, or in the briefing. So what happens is that when you are a clearing member with SGX, you have to park money with them, otherwise they won't let you trade. Or if you are a clearing member and you buy, I don't know, 500 million of trades and you don't. But so how much you can trade with or trade with SGX or clear with SGX, you have to depends on how much collateral you put. So they have a 14 billion of float, and they actually share some of it with, of course, some of it, not everything goes to SGX. Some of it actually goes to the clearing member. But of course, if they can make 135 million, obviously a lot of it goes to them. For I'm not sure how much work they do, but so we just think there's a lot of upside for SGX, and this could give them like 20 percentage points of earnings growth, again without doing much, I think. Yeah. Okay, next slide. So the next one is CLI, which stands for Capital Land Investment. So we like it firstly because of the model, as the title suggests, real estate cradle to grave. So just let me explain a little bit. I mean, why we try to come up with this type of name that nobody understands. But so what they do is that they can cradle. What we mean is that they can take a piece of property. They're strong, namely in service apartments and also in malls. I mean, they are strong, and of course, you need to be strong in this because these are more management intensive. I think if you're operating an office, there's really not much. You just make sure that you collect money from the tenant. But if you're running a mall, you need a lot of management expertise. You need to refresh the mall, you need to attract tenants. So what they do is, the model is that a piece of land, they can build it, and most important, they can tenant it out. Then when we say, so from cradle, so they can build something from cradle. When we say go to the grave, doesn't mean it's the demise. So what I mean is that they can sell this property either to their own REITs at a huge gain, or sell it to their own private equity. So they have like 6 REITs, so they own 6 REITs. So they can sell it to their own private equity funds that they manage. So the next phase, they can still make money even after selling it, which I think which not many people can do, is because they own these funds. So they own the REITs, they can still earn management fee this every year, and management fee on REITs is the best money, because if you run any fund, you always worry customer redemption. But in a REIT, there's no customer redemption. To redeem, you need 50% of investors to vote you out. And CapitaLand already own 20%, so it's quite a high hurdle to try and get them out. So it's a very, very high quality, and they own, I think, 5 REITs in Singapore, if I'm not mistaken. Anyway, I'm not the analyst, but so they operate 5 REITs in Singapore, REITs in Singapore. So the table here is basically the amount of revenue they make from real estate investments, which means the actual property they own on the balance sheet, which is the REITs itself, and some malls or offices they own. The red line is where they're trying to grow the most. This is fee related. So the fee now, the funds under management has grown from 80 billion, and they have commitments to grow it up to 90 plus billion. So this model, of course, is good, but in last year it doesn't work because China locked down and most of their assets are also in China. So 1/3 of their earnings come from China, and that collapsed to only 10% because lockdowns and they have to give rebates. And the model doesn't work last year because interest rates continue to rise. So there's very little transactions. So they benefit when there's property transactions. So this model will work now when China is reopening. Then they can secure more funds, they can do more acquisitions and so forth. Okay, next slide. Oh, so the next one, okay, I'm not able this company again. So I knew the next one is ComfortDelGro. So we like it because of the red line, which is the earnings recovery. So the earnings recovery definitely stalled in 2022 because they still have to give taxi rebates, and they still have to have for Comfort, they suffered because all the UK, especially in UK, they have to pay higher bus wages and so forth. But in 2023, the recovery, because all these things they can only recover in 2023. So whatever wages, they can only recover through higher inflation when they do the bus contracting fees are pegged to inflation. And of course, in Singapore, train fares have also increased by, I think, 18%, I mean, more or less. So that will also be a benefit for them. And for the taxis, the rebates we think will be the same, but not what they have done is they start to charge on booking fee. So they start to operate like a Grab, but not a mini Grab. So that is another additional revenue. So the other story for them is also a balance sheet story. So if you look at the bar here, pre-pandemic, they had net cash of 64 million, and then they exited the pandemic with 10 times more cash. But of course, nobody cares. Everybody just want to look at whether there's earnings. But at least you know that they can grow their dividends because there's more than enough cash to raise the dividends. Next slide. I think dividend yield excluding the special probably 4%. Yeah. So the last one we have, we added PropNex because firstly they have an attractive dividend yield of 7%, and the dividend yield is based on the earnings of 50 million, which they can generate. They generated, so they can pay out of the current cash flow. And even if for whatever reason the earnings doesn't improve this year, they got 140 million of cash standby, and management have pointed out many times that they want to be a high dividend stock. So even if there's a shortfall a little bit, I think they can more than easily top it up, because in this model there's really little cash, very little capex, so it's almost pure cash for them. Most of the cash is really working capital they need is tied up in trade debtors, which is already tied up, so like 200 million, but most of it is just waiting for developers after they sell the units. So this bar here shows the earnings, the blue bar is the profit, and you can see that the red line is, we thought earnings would drop. So actually we were expecting 20-30% drop in earnings for them because the red line was collapsing. So the red line is transactions in Singapore. We are talking about new launches transactions and then secondary transactions. So although transactions were down, they still managed to maintain profit because they took a lot of market share. The blue line is HDB resale, but of course there's also rental that did well, which we didn't show. And the other benefit for them is, of course, when property price increase, because they are based on the percentage of the property. So that is also another benefit for them. Okay, next slide. I think that should more or less be the conclusion. I think I won't run through. Next slide. Next slide. The events. Do you have the slides on the upcoming events? Okay, so just to take note, we have these 3 events coming up. I think this is tomorrow. So this is a US company. So if you want to know more about 3D printing, I'm not sure whether they do it for weapons, but anyway, 3D printing is, if you want to know more about 3D printing, then this is a US company, then you can, I guess, learn a bit about it. Then we have another event on the 5th of April. So this is also another interesting event, at least for me, because we have Thailand, our head of research for Thailand will be there. So if you want to know more about Thailand, not so much whether to go there as a holiday, but it's just to, if you want to know what's latest on politics, not what's latest on Thailand, the market. And I guess if you're a Thai beverage shareholder, maybe you want to know more to what's going on in Thailand consumer. The other interesting part is our Turkey head of research will also be there. So, we always talk about inflation, property being a hedge for high inflation. I guess this is the experiment. This is a real world study because Turkey has been famous for a lot of inflation. So, if you want to know whether property prices really hold in a high inflation, I think you can ask them, because I also do not know and I also want to find out. I think the stock market in Turkey is up 100% because everyone because the inflation is so high, they need to generate return. Everyone went to the stock market. But again, if you want to know more, just dial into that. It's not a presentation, it's a roundtable discussion. And of course, on the 6th, we have our US team doing their strategy, mainly focused on the tech names. So do sign up for that. Just go to the Poems website, the education that you normally do. Okay, I think we can go to Q&A. Yeah.
Hi, Paul. Hi, Ryan. Okay, so there's a question here on Tesla. Any comments on Tesla's latest reporting about missing deliveries? What are the views on the EV market in the upcoming months? So just a disclaimer, we don't actually cover Tesla, but in terms of their deliveries, I think they had like 423,000 deliveries for the first quarter of this year, and that's like a 36% year-on-year increase. I think when you first of all, when you look back at I guess their deliveries chart, right? They've always been, I guess they've just been trending upwards and upwards, especially as they open more factories. So they opened 2 gigafactories in, I believe it's Giga Berlin and Austin in 2022, and that just helps to generate production for the company. When you look back into the second and first quarter of last year, I believe in the second quarter of last year, there was a real deliveries drop compared to the first quarter, mainly due to, I believe, a lot of weakness in China. But now I guess as China has opened up and EVs have become a little bit more popular, we should expect deliveries in the second quarter of this year to definitely be more than 36% year-on-year. But I guess just to put this into some context, for the first quarter, they basically delivered almost the same amount of EV cars as the whole BMW network for 2022. So that's BMW and Mini Cooper cars. So I guess in terms of the outlook, obviously the EV industry is gaining a lot of traction, especially with a lot of governments basically trying to extinguish or eliminate internal combustion engines by 2030, 2040. So in terms of like long run, there's definitely a lot of room for Tesla to grow, especially since they are still the main dominant player in the EV marketplace. Sorry, a bit long-winded, but I hope that answers your question. That's all from me. Thanks. Hand it back to the rest of you.
There are a couple questions on the REITs. So the first one is a prime US REIT has bottom. Is the payout ratio, is the payout reasonable enough to sustain going forward? Yeah, so the TA part, I'll leave it to Zain later. But for the FA part, the payout, even if prime right now, they're paying over 20% dividend based on the most latest share price of about 33 cents, if I'm not wrong. So even if their results, their DPU drop by, like, let's say 10%, they're still paying a decent, like, high teens or even still 20% dividend. So you think, yeah, it is still reasonable to enter because of how cheap it is at the moment. Yeah, I'll leave the TA part to Zain. Okay. Please comment on outlook on DC REITs. So for data center REITs, like especially in Singapore, there's still a limited supply. So the valuations of these data centers are still okay, still increasing slowly. Yep. But as a whole, in general, a lot of these hyperscalers, they are looking to invest in their own data centers. So the demand there might slow down for some of these data center REITs. If a lot of these hyperscalers, they start pulling out and building their own data centers. But if you look at it as a data center, as a whole, right, data centers are still, it's a secular growth, still demand, especially when AI, all these starts to come in. So yeah, as a whole, it's still quite a lot of demand there. About the hedge and unhedged chart, could you comment on which REITs would benefit more if the Fed pause or reduce interest rates going forward? So just now the hedge and unhedged chart, yeah, I didn't include the how many percent of each REIT that are hedged. So if you think about it, if let's say the Fed reduce their interest rates, you actually want a REIT that is not fully hedged going forward. Because if they fully, sorry, let me rephrase that. So if you believe the Fed has paused or actually will reduce rates, you don't want a REIT to kind of fully hedge going forward, because if you fully hedge going forward, then you kind of locking the high rates. But we have to see at what rate the REITs actually hedge their interest at. So if they hedged it maybe in 2020, it's definitely a good thing, because the rates, the Fed rate there was at 0 to 25 basis points, as compared to if you hedge your rate, like let's say now, that would be, the Fed rate is at 5%. So it's definitely a difference. So you have to see when exactly the REIT hedged and at what rate before we can comment further whether which REIT will benefit. Yeah, there's some homework to be done there. That's why I can't really give you an answer straight up on this question. Like which REIT will benefit most. Actually, all REITs tend to benefit, because if interest rates go down, they can have their interest expense will be lower on the floating portion. What is your 3 REIT pick? So yeah, 2 of them I already said earlier, FCT and Escort. The other one is, I think Paul mentioned before that we took it up from the Model 10 portfolio, but actually we still have a buy call, and we still like the mainly because they are trading at really steep discounts now at like 0.445 times price to book, and they're paying over 20% dividend. And their asset, they only have one asset near the they have 3 assets in California, but one asset is near the downtown LA area. So that's the one that is kind of risky, but the other assets are okay. So even if, like I mentioned earlier, even if let's say Prime US, the DPU dropped by 10% in FY23, they're still paying high teens dividend yield based on the share price that is today. Can you give your views on Paragon REIT, its payout ratio, and what growth catalyst is there? So for Paragon REIT, its payout ratio is 100%. They pay out all of their income. And what growth catalyst is there? So Paragon REIT, they're still seeing negative rental reversions in their main mall, which is Paragon. But then they think going forward, because of the sentiment in the sales, and they believe that these rental reversions can turn to positive territory in the next couple of quarters, especially since it's kind of Paragon is a premium mall in this in Orchard area. So when the Chinese come back, they also will tend to shop around there. So with the return in Chinese travelers there, so they can expect higher tenant sales in Paragon REIT as well. In Paragon rather. Yeah, so that is a catalyst for me. Yeah, I think that's all for me for now. I think I'll hand the time over to my colleagues.
Okay, yeah, thanks. So let me just try to answer since okay, most of the analysts are not here today. Could you comment on what Yanlot does? So Yanlot is a property developer, mainly in China, but they are mainly focused on tier 1 cities, or they call it the new tier 1, which I'm not sure what that actually means, but they're mainly focused on tier 1. So developers in China, most important is to be that those in tier 1, tier 1, because tier 2, tier 3 also a bit worried because of the whole inventory situation. Because in China right now, the worry is just that a lot of projects are not completed. So the focus now is just to get those uncompleted projects done, and that means you try to launch anything, that's not going to happen because the authorities is just focused on uncompleted, and the best demand demand situation is still the tier 1. So their developer, I guess the owner is, I guess, converted, is a Singaporean. Yeah, not much else I can say. Yeah. Please comment on the impact of DBS recent outage. Do you think the drop in share price is knee-jerk reaction? Yeah, okay. We can only take reference to the previous time they had such a outage. I think that was in November 21. So what the MAS does is that they will penalize you and then say that your CET1, you know, when the banks have a certain CET level to meet, so they will just penalize you, say, oh, you cannot lend out, your CET1 will in effect come down. But the problem is DBS already has too much CET. Yeah, so in a way, the impact to them wasn't really much, although on papers like almost $1 billion, the probably estimate. But this means that this amount of capital you cannot use if you want to lend, but they already had too much capital. I mean, I think the regulatory requirements probably 8% or more. They have about almost 14+%, so they got more than enough capital. So the financial impact, if you follow what happened in November 21, isn't that huge. I mean, maybe there's some reputation impact. Maybe they should use Silver Lake software like the rest. But anyway, yeah. So in terms of the financial impact, sorry, just to go back, financial impact isn't that much. Yeah, if you follow the same playbook that the MES did, because there wasn't any financial penalties, if I'm not mistaken. It's more a penalty on the capital. Please comment on the debt load of Keppel Corp. What do you see the growth? What do you see is growth to be in next year? So, like we mentioned, Keppel Corp is all about property sales. So the story won't be as exciting as well, but they've got, just that they have a lot of land bank to dispose of. The debt load, okay, I got to come back to you on the actual debt load, because what we see in the balance sheet now, the 9 billion or 0.8 times gearing, some of it includes Keppel Offshore Marine. So I don't have the clean number, so sorry. So I need to get back to you on that because I don't really cover Keppel Corp. Or you just post the question in our community there, and at least we give us some time to try to give you a better answer if you want to. If you still have the same question, just post it in the community app in this in the slide here. Okay. Let me try to move on. What is the time period, first half, second half? Do you think the Fed recognized that we're heading to recession, or would you think it's already beginning, or just we do not feel it yet? I still think it's in the second half. The reason why is because the services sector is still performing well, and you know, services, for goods sector, we can tell you the inflation is coming down because the inputs are coming down, like commodity price. But for services, what is the input for services is wages, essentially. So that will take a bit longer to come down. And because wages is still rising in the US, so we think it's more of a second half story. Okay, for the technicals, just give us a minute. We'll definitely Zain will by 12:30. Zain will address all the technicals. Of all the Singapore property companies, excluding which is a better stock to buy. The problem is there isn't really many Singapore property companies. The other one that might look interesting is Gorko Land, because Gorko Land has Midtown development, and that has already been more or less fully tenanted out. I'm not sure about dividend yet. I didn't have time to look, but the best story for a developer is that if the developer can give you a good yield, maybe 4 or 5%, and from the recurrent income, because some of these developers have rental. So if a developer can give you 4 or 5% income from recurrent rental that they get from the office, then at least you can just wait on for the upside because they got development profit, and whenever they sell this property, you get this huge jump in earnings. Yeah. So because for Singapore, most developers will trade at discount to book. That means whatever value you think, the market will just discount you. And you also seen some privatization and maybe 40-50% price to book. I don't have the exact number, like Perennial, Roxy, they're all privatized because the market don't give much value to developers. I mean, that's the problem we have. Because property developers, the earnings is quite volatile. And of course, if you're developing in Singapore, you're always subject to risk of property intervention. I guess, maybe that's the reason why investors don't like property development. Like in the past, and developers used to trade very close to book. I'm talking about maybe the early 2000 or more. Yeah. So, but the only two is CDL and Gokko Land. Yeah. Will Wee Chung's high salary search cause UOB shareholders getting less dividend? No, I don't think so. Yeah. I think the dividends is in the billions. Yeah. So I don't have the exact number, but if you assume they make 4 or 5 billion, they pay 50%. Yeah, it's more. Yeah. No, it won't. Yeah. But regardless, I think he compared to some of those US CEOs, maybe he's paid less than that. Oh yeah, sorry, Paul. What is CASA? Yeah, my apologies. Yeah, I should actually explain the acronym. That's something which we always must explain. But so CASA is basically current account savings account. Yeah. So CASA is basically is the deposits, and they hardly pay us any interest. Yeah. But of course that is declining. But what we're saying is the degree, it won't decline, it won't go to zero. So because all these banks have been making efforts to do money management with all the corporates, so they've been doing. Not money management is a better way to explain it, but I forgot the term. But they actually work with a lot of corporates to do all the payroll sweep and everything. So that's why like DBS, of course, DBS different because they have a post savings bank, a postal bank behind it. But a lot of the other banks have been trying to have like money management kind of incentives, try to get all these corporates on board so that they can do payroll processing, and they can get all these current account, savings account, zero interest. Loans, you call it deposits. You can think of it like loans. Yeah. Hi, Paul. Why are security losses in SVB in P&L, but in Singapore in balance sheet? Yeah. So for SVB, Silicon Valley Bank, so when you buy all these government securities, you either hold it, held for trading, they call it. Basically, it's trading is for short-term purpose. So if you make or lose money, you have to recognize in P&L. Then of course everybody will see, oh, P&L. But for held to maturity means, which the central banks allowed it, is that you don't recognize. You can keep, even if you make losses, 99% loss, you don't have to recognize because you can redeem. So it's like you own a bond or FD, of course not FD, but if it's an FD, eventually you're going to get back all your money unless the government collapses in the US, but you don't. So Singapore also has it, but I think the accounting treatment is the same. So for Singapore, some of it, they call it fair value to OCI. Basically, it's a fancy name, but fair value to comprehensive income. So it depends how the banks recognize. So if you say you want to hold it short term, then you have to recognize in P&L. You want to hold it long term, then you recognize. You don't have to recognize. But Singapore banks don't have so much. So they do recognize. If you go take the bank balance sheet, I think most of us don't. But if you don't do that, you will see they do recognize some of it. So Singapore also recognizes, but just that we don't have so much as them. Yeah. So there is no difference in accounting treatment. It's just the degree of how much. So SVB just took everything, and rather than lend it, they just put it all in government securities, which is not the wrong thing like we mentioned before. No, it's the safest asset, right? Government, and the most liquid. But just that there was interest rate risk. So there's other risks when you buy a government bond. May I know what are the stocks in the construction sector? Lianbing is probably one. Chip Insing also wasn't pure construction. They mainly made a lot of profits. The main ones is, I think, Lianbing is probably the biggest. If you there's OKP also, but OKP mainly do roads, not so much. Also infrastructure, not so much construction. So I think OKP is also another construction company. Yeah. And there are a few more, but these are the ones that stick out in my mind because most of them are like half. Most of them make money from property development. Might as well, right? Since you're going to, rather than help your client, the developer make money, you might as well just do it yourself. Okay, I will try to. Any disadvantage for micromechanics as compared to other? I wouldn't call disadvantage, but the only thing is they are more in the back end. So back end, again, just to try to different. So front end is those like, TSMC is considered front end. They make the wafer fab. Those, if you Google those round circular thing like a frisbee, the actual wafer. So that is the highest end. But for micromechanics, they do the back end, which is the packaging and testing. So what it means is that they will, after this thing, it has all the circuitry, all the lithograph has been done, they package it. So that you just call it a bit lower end. It's not low end, but it's just lower end compared to front end. And the capex spend, because most of the money is usually on the front end. One machine can be as the famous ASML, one machine can be almost as much as 500 million. She's not going to get it on the back end. So that may be the only, but again, micromechanics is also pushing towards the front end. So in the US, they're trying to do some. So that's I wouldn't say disadvantage, that's the only difference. Yeah. With the US tech curves, please comment on AAM, UMS, Franken venture. So the US tech curves did hit them because their customers get hit. I don't have the exact number, how much it impacted. I'm not sure if Max has, but when I know like Lam Research, they probably lost like 200 million of revenue or more, or maybe 200 million per quarter. I'm not sure the exact amount. So that in the end also affected UMS and EMS, because if these are their customers and their customers now lost a customer, so Applied Materials also lost customers because they cannot sell to China. So this will also affect them. For venture, maybe venture benefit because of the high tariffs, during Donald Trump, they imposed a lot of tariffs. So a lot of the multinationals shifted out manufacturing to Southeast Asia. So venture benefited from this so-called tech curbs, I guess, if you're asking about that. What's your outlook for Raffles Medical? Will it break? Okay, this one I'm going to leave it to Zain. Hi, Paul. Will all prices and US dollar affect the earnings of and US dollar? No, because they make in US dollar. US dollar not really. Okay. The reason why I hesitate is for China Aviation, there's two parts of the business. There's the all trading. So all trading has a very low margin. You just pick up two phones. Hello, you want to buy, then you want to sell. So how much margin can you make on that? I'm totally exaggerating, but the way the trading made, if there's contango, because if the oil price spike up, that means sorry, this might be a bit complicated, but if the longer end price, that means the 3-month oil price is more than the current price, then of course people will store, and then since it's higher, I might as well store it and then sell it later on. So they benefit on that because they got storage. And they also benefit last year because Ukraine, so China had excess jet fuel, then they can just transfer to and they make. Oil price may not really affect them that much. Maybe working capital they might need a bit, because for jet fueling is a cost plus business. The cost plus is a plus on the per barrel. It's not gonna, so even cost plus, though, you be careful. Is it cost plus on the selling price or cost plus on the per barrel? So theirs is more cost. It's a plus on a per barrel basis. So they are not that affected. And on that front, on US dollar, I think it's quite minimal for them, but I need to double check to be exact about it right now. Your view on the oil cut by Saudi year to date is impact on REX. So okay, so for REX, I think the derating for REX is because they started to go into drone. Don't ask me why they go into drone from all expert. It's like Shell suddenly decide they want to go into the drone business, which I have no idea how it's related. But anyway, of course, high oil price will benefit REX because they are producer. It will benefit RH Gas, Petrogas because they are explorer. They'll benefit Dynamac indirectly because Dynamac build top site for FPSO. So of course, if oil price is up, then there's more certainty that a lot of these projects will get FID. That means they get approval and they'll get developed. So the one of their main customer, SBM Offshore. So of this FPSO, for those who don't know, they are they are like a floating production. That means instead, sometimes you see on TV those facilities that produce oil, but those are on land. So this is floating because for deep sea, you for deep sea you need something floating. You can't pipe it all the way onshore, be too far away. So these are like a floating production. SBM offshore thinks there's almost another 36 for the next 3 years. That means one every month. I'm not sure whether that's going to happen, but it's going to be optimistic. Yeah. Okay. I tried to answer one or two more. Then I think we try to push it to Zain. You mentioned applied materials expand capacity in Singapore. Would there positive impact? Yes. They will definitely impact. They'll definitely benefit since they're going to open a 600 million factory in Singapore. So obviously they're going to look for all the not obvious. I mean, most likely they're going to look for all the supply chain which is nearby, and of course, UMS will be one of the beneficiaries. Yeah. Singapore was already a center, but was already a center for applied, but they're just going to make it even bigger this year. Yeah. How does SGX earn money from treasury when it's rising? So they make from actually, like we mentioned earlier, from the float, from all the clearing members giving parking money with them. So, yeah, actually it's quite a lot. I'm surprised that they make, but you think about it, 14 billion, 1 percentage points is 1.4 billion. Of course, they don't make that much because they actually give back some of this interest to the clearing members, but they make it especially if the yield curve is up. So they give the money, they give them overnight money, but the anything more they will take it. And there's a lot. I mean, 134 million from just interest income. Of course, some of it is their own, but it's mainly from the float. Yeah, I'm sorry if I'm confusing you, but it's mainly from the collateral balance that they make. Raffles Medical has been moving based on more China growth or Singapore, or it's mainly Singapore. China is still loss making. What is our target price? I can't. But okay, the only thing for Raffles is that they might lose a bit of because vaccination. They also made quite a bit of money from a vaccination center. So one of the areas that with the recent news, right? So there's less vaccination. Let me get back to you on the target price because there's too many stocks I can't remember. Okay. So let me just answer this last one before I hand it to Zain. Our target price is 176. Yeah. And hospitals, I know the valuations are 20, 30 times, but hospitals can trade as high as 50 times PE based on private transactions. Yeah. Okay. There's one question on the chat. Can you comment on Wilmar share price? I think this is the last. If you do have questions, do post it in the Q&A so at least we can track. But for Wilmar, we think it will be a bit challenging year this year. Last year was exceptionally good for Wilmar because, of course, palm oil price was up, but also because when in Indonesia, when there was a lockdown, when there was a ban on oil palm CPO export, they actually benefited because they actually stored a lot of this oil, and hey, miraculously, the ban was lifted, and then they had so much of this, I guess, affordable palm oil which they could now export. So they made a huge. So we don't think Wilmar's earnings first half will be good. Second half will be a bit better. Will be better, but it all depends on China. It depends on their YKK, which sells edible oil, and of course soybean crushing. But we think first half will be weak. I think if you look at any palm oil companies now. All palm oil price hit as high as 8,000 and now it's about 3,000. So obviously earnings won't be that great. But so Wilmar is no surprise to being first half being weak. Answer so many questions. Let me hand it to Zain.
Hey, thanks, Paul. Just give me a moment. I'm loading up my trading view. Okay.
Which community group should I post my question on? Yeah, so sorry. Yeah, I think you should post it in our Singapore research. Yeah. Oh, you do not see a response? Oh, I think you should see a response. Yeah. We generally respond to all the questions. Yeah. So just go to the research community. Yeah. Then you see most of the analyst posts. Sorry, Zain, please over to you. Yeah.
Okay. Thanks, Paul. Okay, so I start off with the first few being the Singapore semicon stocks. So first one is AEM. For AEM, actually, the trend is quite good now. But near term wise, there could be some resistance ahead. So the thing is that we actually recovered from this sell down, and then we actually looks like there was a breakout of this downtrend channel over here. So currently price is around touching the 327 previous support level over here. So we could be moving a little bit more upwards to possibly fill this gap at around $3.34. But over here, previous support could turn into a resistance over here. So that's something to take note. Then current support could be a retest of this breakout of the channel over here, which is could be around 315, 316 over here for now. Yeah. The next one is UMS. So UMS also looks like we are currently trading above this downtrend channel pullback over here for now. So but over here we can see that previously there was some resistance coming around $1.16. So that's a level to take note over here. Then for now the support could possibly be around at 110. So 110 being a previous support over here that we actually broke down, and then we recover back over it. So these few days we actually see support coming at 110, which could hold for the next few days for now. Okay, then moving on to ISDN. Okay, ISDN looks like we managed to clear this resistance at around 50.5 cents over here. We are just sideways for now. So going ahead, if we do continue to go up, let me see the next resistance level. The next level could be around 53 to about 53 and to about 53.5 cents level, which is the 50% Fibonacci retracement level. When we take the highs at around 61 cents and low at 45.5 cents over here. Yeah. When it has prime USB bottom, let me look at it from a chart point of view. Okay, for prime, let's see. So because actually prime has been making a new low over here, but then looking at the indicator wise, we haven't seen any bullish divergence signal over here. So we can't say with a high level of confidence that this bottom has been made over here. Then looking at it for now, it looks like a short-term dead cat bounce. We are retesting a previous swing low support, now possibly turn resistance near around 34 cents level. Then over here a bit further up around 36 cents level, there could be some resistance as well. Because over here we see that there was some sideways movement over here before a breakdown that occurred. And then we could be retesting a downtrend channel resistance over here in this stretch. Yeah. So this region could act as some short-term resistance for now for prime. So hopefully if we want to see that it has bottomed for the near term, means that hopefully we see a higher low being formed, then we see a breakout after that. That will be better. Okay, moving on to the Hong Kong stocks. So the first one, 3032, Hang Seng Investment Management Tech ETF. Currently we have actually broke out of this downtrend channel pullback over here, currently just trending upwards for now. We also cleared a previous resistance around 4.23 over here. Then we just around sideways over here for now. So we could expect that to continue. So but then if we make a pullback, the current support will probably be this swing lows around here around 4.04 around here. Yeah. Then the next resistance upward to take note will be around 4.4, close to 4.4, which is a prior range support that was being broken down, as well as a resistance over here upon the retest last time. Okay, for Tencent, We also broke out of this downtrend channel over here. We've been trending upwards for now. Thing is that we also cleared this intermediate swing high around 373, around 373 to 375. There was a prior support, range support over here. So this is a key horizontal level to stay above to continue this bullish movement upwards. Currently, we are seeing resistance around 397 over here, which was a prior swing high over here. So for now, I think that these two lines are the support and resistance levels. We could currently consolidate in a bit of a range for now. Before we if we find some support at these levels, then we could continue the bullish momentum upwards to maybe retest these highs around the previous highs around 416 over here. But in the case, if let's say we break below these 375, right, then we must see then also these lows, this swing low here around 362, then that might be some caution that we might actually pull back maybe to retest this breakout that took place over here. So these are some of the possible scenarios that could take place. Okay, for JD, similarly, we also see the breakout over here. Okay, some gapping. Looks like we feel a gap over here around the close to the 176, 178 level over here. So currently we're seeing a little bit of a small retracement. Volume today looks like it's quite low. So for now, could be some minor pullback. For now, could possibly retest this previous horizontal resistance that could act as a support over here for now. So around the 162 to 163, around here could become the short-term support. Then resistance upwards, if we continue to move upwards, probably be around 185 to about 192 level over here. So that being a previous swing low support over here, then we can see over here it turned into a resistance zone over here. Okay, last but not least, Ping An Insurance. For Ping An, I think currently we could be potentially in a bullish pattern over here. So this is actually a descending wedge, which is a bullish pattern. We are still consolidating for now. We can see quite a bit of sideways movement over here for quite some time already. So resistance here is 53 over here, the previous support. Then we can see quite obvious resistance over here. And the support is close to about $50 for now. Yeah. A lower support could be near $48, which is a 50% Fibonacci retracement level over here in this stretch. Then we can take some support from this wedge support over here as well if it decides to actually pull back. If not, a breakout that occur over here, we could see maybe price go up to $56 in the near term, which is another resistance level upwards that was a prior support over here. So 56 to about 58 over here, that will probably be the next resistance level if we do see a breakout in the near term. Okay, then I move on to the local banks. Okay, DBS, OCBC, and UOB. Okay, DBS currently, I think after we saw a break out of this downtrend channel over here, currently we see some resistance take place near the $33.70 to about $33.90 level over here. Price has been sideways and we see unable to clear higher for now. So currently we are doing a little bit of a pullback. It seems that that's the case. So support wise, I think could be at around this previous resistance over here, around 32.82 to 32.80, 32.90 for now. Then the lower end could be near 32.30 over here, which is this swing lows over here. Yeah. Then possibly if let's say price come back deeper, we could possibly retest this downtrend channel breakout over here as well. Okay, then for OCBC, we are out of this downtrend channel pullback for now as well. We also cleared this around 1240, this short-term resistance over here. So we see net price actually just sideways over here currently. That could continue. But if we do clear, let's say the highs over here will be 1260. Possibly price might move up to next level near closer to 1280 over here, which is the next swing high over here. And support wise could range maybe downwards to close to 18 over here, which is a retest of this downtrend channel breakout. Yeah. And last but not least, I talk about UOB. Okay, UOB currently looks like some resistance near this. There was a bounce over here in this stretch. Currently looks like some resistance is coming near the $30 mark over here. Price could see some form of short-term pullback for now. With some support maybe near the 2950 level, which was this horizontal level that we broke out of. Then a lower support could be near 2915 over here, which is the swing lows over here, and a prior support over here. Yeah. Currently looks like possibly just some form of consolidation for now for the three banks. The next one is Sarin Tech. On Sarin Tech, I think currently we've seen some form of rebound. Short-term resistance, we could possibly retest this range from about 47.5 cents to 50 cents region over here, which is the previous short-term highs from in January this year. And for short-term support wise, if we see some form of pullback, it could come at around the 44 cents level, which is a short-term swing low over here before the continued ascent over here. And then prior, we can see previously this was some sort of a range support level over here as well. So, and then over here there's a possible trend line support coming in also for Sarin. Yeah. So for now, I think for this stretch, it looks like possibly just a double top retest. Given we had a swing high form over here, and then we had quite a deep pullback over here in this stretch. Okay, and Thai Bev. Okay, Thai Bev, we are out of this downtrend channel over here. So we had a retest at around 63 cents. Looks like currently, based on today's candle, we are finding some support over here. So short-term resistance, why we need to see clear this stubborn resistance currently at around 65.5 cents to 66 cents level. There was a prior, which was a prior range support, currently a strong resistance over here. Then possibly we could see price move up to maybe 67 cents to 68 cents level, which was another previous range support that broke down over here. If the support here doesn't hold at 63 cents, then maybe we could see a retest of the recent lows around 61.5 cents over here. Okay, then the HST ETF. So for this, we had a break of this downtrend channel over here. Then currently price is retesting these swing highs around the 70.5 cents level. Yeah, retested it. So currently we are currently price just sideways over here for now. But the next level to move, we could move up higher if we clear this level, will probably be at around this 73.5 cents level. You can see this was a previous range support January, then in February as well, then before the breakdown and a retest before moving lower. So upon a retest over here, that could be a strong resistance upwards over here. Then support wise, we could be looking at about maybe 67.5 cents, which is a swing low over here for now. Prior range support over here. Then lower end could be maybe at 65 cents. That could represent a retest of this channel breakout over here. And next one is Mapletree Logistics. Also for Mapletree Logistics, I think we are currently retesting the key resistance at around $1.77, $1.77 over here, which has acted as a resistance quite a few occasions over here. So over here, if could be the same unless we see a more powerful break that takes place, then maybe the next level to look at is probably 181 over here. That's sure. 181, that will probably be a next level to take. Yeah. Then if not now, currently the support looks to be close to 170 to 172 over here, which is this level that we broke out of over here. Far East Hospitality. Okay, so for Far East Hospitality, currently looks like a pullback over here that is taking place. So we're just in a pullback channel for now. For support wise, let's see from a Fibonacci level, let's see where it could occur at. Possibly we are currently we touched the 50% retracement level near the 58 cents mark. Then we sort of rebounded for now. Okay, so this is a short-term reference to look at. Next lower support could be near 56.5 cents over here, which is 61.8% level. So if that's in the case, let's say we find support over here, then price managed to break out of this short-term resistance, then the next level to look at would probably be around 61.5 cents, which is this horizontal range support that we actually broke down of. And next one is CLI. CLI. The CLI looks like currently possible breakout of this downtrend resistance line over here. So this was after price had sort of consolidated over here previously in this stretch. So if this is a true breakout, then we could see maybe price try to retest about near 380 over here, which was previous range support level over here for now in the midterm. And higher on the resistance probably at around 390 over here. Short-term support could possibly be at around 370 if we see a nice breakout. Yeah. The next one is Escort. For Escort, ever since we broke down this uptrend channel, we have just been sideways over here. So it looks like nothing much has changed. Yeah, so the support we can draw reference near the around the 98 cents to about 99 cents level over here. Then resistance is upwards at 102 to 103 over here. Yeah. So nothing much has changed. If we see price pull back lower, then the next support probably be around 95.5 cents to about 96.5 cents over here, which was a previous resistance. Then we see a break higher, the next level to look at probably be around 105 to 106 over here. Okay, this one China Aviation. China Aviation, we've seen currently looks like a possible break of a downtrend channel pullback over here. We could retest this and a previous uptrend line support that we've broken out of. So the resistance upwards could be around $1 to about $1.03 over here. Yeah. Support wise, currently I think it's about 97.5 cents to about 98 cents over here, which is this breakout over here. And where we sideways for a while. Yeah. Okay, so okay, I think it's about one. So maybe I go through like one or two more. Yeah. So best world, we had a breakout of this falling wedge pattern over here, which is descending wedge, which is bullish. So currently I think that if sideways for now, if price continue to ascend, then we could well retest this 255 recent swing high over here. Then the next resistance level could be around 266, which was another previous high. Yeah. Then short-term support, I think will be this sideways range over here around 240, 246, 247. Yeah. Okay. And maybe I go through one more on Capital DC. Okay, for Capital DC, still pretty strong. We see that overall there's a big, the main trend is this uptrend channel over here. Then there was a short-term pullback in the descending wedge. Then we continued the bullish momentum upwards. So for now, the resistance could be around the 209 to about 212, this range over here. Then support-wise, you could see some support coming in around from close to $2 onwards to about $2.03 over here. So still remaining quite strong in some sort of range over here. Yeah. Okay, I think I'll go through until here today in view of time. For the remaining questions, I have quite a lot of questions. Please feel free to just ask in the P3 Telegram P3 Technical Analysis community group. Yeah, then I'll answer your questions over there. I think now I'll pass on my time back to Paul for any closing remarks.
Yeah, okay, yeah, thanks. I forgot to answer this one. So this one came in quite early. So because it's such a recent, due to the OPEC cuts to all supply, what's the shorter term view and longer term result? So it's a big negative when you, because what happens now that if oil price continue to spike up, then we will, the hard landing scenario will happen. So what we mean by that is that if oil price spikes up, then there's almost no limit to how much the Fed can raise rates, because then inflation could actually run away even harder, and the Fed has to really step on the brake. So that's what I mean by the hard landing scenario may come into the conversation again, because it's negative, because inflation will, I don't know, who knows what's the limit if oil rises to 150 or even $200. I'm not saying it will, I'm not saying that's the worry we always have. The one way to hedge it is, of course, just buy oil itself, or to buy renewables. That's the other way to hedge any surge in oil price, because renewables also benefit from higher oil price. Yeah, well, okay. I just thought I mentioned this, since this is one of the hot topics now, I guess. So with that, I'd like to thank everybody for your time. Sorry if those who've already attended our strategy, listen again, because that's what we normally do. Yeah. Okay. With that, I'd like to thank everybody. Have a good week again, and thanks again for your questions. If you have anything else, just feel free to type it in the community, either the technical part or the Singapore analyst. Okay. With that, thanks everyone.